Welcome back friends. In the earlier video, we have discussed about benefits and some key features of mutual fund investing. Also we have discussed about the liquid funds. Our today's topic is especially the debt-oriented schemes. Before we begin, just an appeal to those who have not seen my earlier video on mutual fund basics, please do watch the same for better understanding. Also please subscribe my channel and share the same with your friends and relatives too. Friends, while investing in mutual funds, you have to check the investment objective of respective scheme before selecting the same for investment. Please do examine whether the objective of the scheme is in line with your requirements and will help you achieve your goals also. Investment objectives predominantly are either capital appreciation or regular income or the combination of both. Capital appreciation is usually derived by growth-oriented schemes, whereas the income is derived from income that is debt schemes, and the combination of both can be derived by hybrid schemes. So let's understand debt schemes. The debt schemes are basically income-oriented schemes, where the time horizon of investment is from more than 3 months to 3 years. Before we discuss debt schemes in details, it is necessary to understand the meaning of debt. Debt simply means borrowings or loans and the earnings are mainly from their interest. So debt schemes usually invest in debt instruments issued by the government, corporates, public sector undertakings, etc., where the tenure varies from short-term to long-term, providing convenience to investors for choosing the right scheme as per their requirements based on their time frame aligned to their goals. Since there are a lot of debt schemes by various mutual funds, you should understand the basics and important terminologies in the mutual fund industry. As described above, the earnings of debt schemes are mainly from their interest. The other earning source of these schemes are due to changes in the prices of the debt instruments like bonds or government securities, that is GSEC held by them. Friends, there is an inverse relationship between the interest rates in the market and the price of the debt instrument. That means when the interest rates in the market go up, the bond with an old lesser rate of interest will be traded at discount to match the yield to maturity. Whereas, when the interest rates will fall in the market, the bond with an old higher rate of interest will be traded at premium to match the yield to maturity. However, the volatility in the prices is mainly depends on the maturity term or tenure of these debt instruments. Averaging the maturities of various instruments of the portfolio is carried out by the funds and provided the average maturity of the scheme is a valuable information for investors' decision making. The volatility of the scheme portfolio is more when the average maturity is higher. In nutshell, while investing in debt funds, you have to consider predominantly the average maturities and align the same with your own requirements. For example, if you want to invest for the tenure of 2 years, you should select schemes where the average maturity is around 2 years or less. Now, let's understand the different types of debt schemes available in the industry, considering different time horizon of investments. Ultra short-term fund. These are money market funds, where the time horizon can be typically 3 to 6 months. Then there are treasury funds or cash management funds where the tenure will be a year or less than a year. Usually these funds deliver slightly better returns than that of liquid funds as the tenure increase. You can check the average maturity to identify these while matching your requirement. Short-term funds. There are various short-term debt funds available with different names, where the investment horizon can be from 1 year to 3 years. These funds invest in the instruments with short tenure ranging between 1 to 3 years. However, small portion of funds can be invested in longer duration with an intention of getting benefits of price movement due to changes in interest rates. However, some of these schemes charge exit load as well. Friends, exit load is a fee charged in case you withdraw the funds earlier than expected, I mean premature withdrawal. The exit load is charged to discourage the investors from exiting the fund till stipulated time. However, the exit load is fund management company's discretion and not applicable for all the schemes. So the exit load, if any, is disclosed in the scheme documents. So, please check the same while investing. Long-term funds. These funds invest majority of their corpus in longer-term debt instruments issued by the government or by corporates. In case of long-term funds, as the average maturity is higher, the scheme portfolio is more volatile and exposed to higher interest rate risk. While investing in these funds, you have to be cautious and aware of the interest rate scenario in the economy. Also, you should have future outlook about the interest rates. Fixed term plans or fixed maturity plans. These are close-ended schemes, where the investments can be done at the beginning when the new fund offer is announced. These funds have a specified fixed term and maturity proceeds are released to investors' account at the end of the term on the predefined maturity date. Since these are close-ended plans, these can't be redeemed like open-ended plans. However, for the convenience of investors, these plans are listed on the stock exchanges. The existing investors of the scheme can sell their units on the stock exchange in case they are desirous to do so. Further, considering investment objectives and investment style, debt funds are named and recognized as under floating rate funds. These funds typically invest in floating rate debt securities, where the interest rates are linked to government securities. Since the interest rates are locked to a certain extent, the NAV fluctuations are lesser in these kind of funds. Diversified debt funds. These funds invest in different kinds of debt instruments issued by the government as well as corporates. The objectives set for these schemes are both, where the liquidity and income is ascertained as well as the capital appreciation by way of gains in the prices of some of the debt instruments. Dynamic debt funds. These funds invest in debt instruments having different tenures. The objective is set to get the benefit of changing interest rate environment, where the income earned by way of capital gains. The fund managers of these schemes strategize investments based on the expected changes in the interest rates. In case they feel the interest rates are going to rise, they keep the fund's investments in short duration, whereas they block the funds for longer period, in case they feel that the interest rates are going to move southwards. Capital protection oriented funds. The prime objective of these funds is to safeguard the initial investments, though it is not guaranteed. These are close-ended schemes, where the certain major percentage of investment is invested in either zero-coupon bonds or in any other debt instruments, wherein the interest earned till the maturity of the scheme along with the invested amount will be equivalent to the entire initial investments. The remaining corpus then invested in equities for getting better returns through capital appreciation. For example, out of initial investment of Rs 100, Rs 80 is invested in zero-coupon bonds or other debt instruments, wherein the maturity amount, that is interest earned and amount invested together, will be equal to the initial investment of Rs 100. The balance amount of Rs 20 out of the initial investment will be invested in equities to improvise the returns on the investments. Balance funds. These are hybrid funds where the initial corpus is invested in debt instruments as well as equities equally, or at a predefined percent, ensuring equities holdings below 65%. Because if the equity holding crosses 65%, the scheme will be treated as equity scheme and not hybrid. The objective of these schemes is to generate income through debt portion of investments and capital appreciation through equities investments. Hence, the name, balanced, itself clarifies the motive of the scheme. Junk bond funds. These funds invest in poor quality of debt instruments to increase the rate of return. The higher returns generated by these funds are at the cost of rising default risk associated due to investments in low credit rated or unrated instruments. Now let's understand what the three key aspects you need to look at while analyzing debt funds. Number 1 is obviously and in general the fund house, fund manager and their reputation. Number 2 is average maturity. You need to align scheme's average maturity with your requirements. Number 3 is yield to maturity. This provides rough estimate of the income you will be able to generate through interest if you hold on to the investment till specified maturity. Friends, now in the next video we will discuss about equity-oriented funds. Hope you liked this video and found useful. If so, please do give me a like, which will encourage me to do more such videos. Please do share the same with your friends and relatives and do subscribe my channel, if you like the same. Thank you and bye for now, till we meet again in the next video.